It's no doubt they're dropping prices, right? They have to move this inventory. But to the point, Gary, it's not working. It's not solving the problem, right? We're not seeing a flood. And the other thing is, why aren't investors going in and buying these houses that are $80,000 undervalued, maybe? It's because a lot of these institutional investors that have Wall Street economists, they know this is not over yet.
Welcome back to Metals and Miners. I'm your host, Gary Boehm. Today, we're diving into the dynamic intersection of real estate markets and economic trends. I'm thrilled to introduce Todd Sachs, the powerhouse broker behind Sachs Realty and the host of the wildly popular Sachs Realty Podcast, boasting over 200,000 subscribers. Todd has become a trusted voice in the industry for his ability to break down today's complex market dynamics. Todd, it's an honor to have you on Metals and Miners. Welcome to the show.
Thanks, Gary. I'm excited to be here. I love your show, love what you're doing, and excited to kind of take you down the housing market path.
Wonderful. All right. So, Todd, we've got a lot of ground to cover, so let's dive in. The U.S. housing market is stuck in neutral. Inventory has climbed for 21 straight months. Prices have stabilized nationally and have fallen from pandemic highs in many once booming metros. Yet sales remain at multi-decade lows, a sign that buyers and sellers are still far apart, with buyers squeezed by high mortgage rates and sellers, they're just slow to adjust expectations. What will those tuning into our conversation today walk away with after listening to this discussion?
Well, Gary, I've been saying since the spring of 2022, and I've been serving the housing market in one way or another for a very long time. Since 1989, I started as a contractor, became a home builder, remodeled houses, got my license in 2005, started a real estate team with a large regional brokerage, started my own company in 2017, Sachs Realty. And I've seen a lot of what we're going through before, but nothing quite like what we have today as far as unaffordability. And I think the biggest takeaway really when you're looking at the overall state of the housing market is people are really dependent upon or hoping for interest rate changes, right? That interest rates will dive back down again. And what a lot of people have to realize is that's how we got into this problem in the first place. So it was suppression of the mortgage interest rate, and I'll show a chart here shortly of how the Federal Reserve really suppressed after the '08 crisis, drove down by buying mortgage-backed securities, mortgages in that 4% range, and then we went down to around 2.75%. So I think the big takeaway here is that we are seeing that, in my opinion, the housing market will continue over the next couple of years to have price reductions. And I think the biggest takeaway is if you can't afford to buy a home right now, don't. Just wait. And, so I think that affordability it's not going to happen like everybody thinks. They say, well, we're going to push down mortgage interest rates and prices are going to skyrocket again. We've seen that happen recently since 2020, and it's not going to happen again anytime soon.
Okay, that's a great intro. The housing market, it's trying to recover from the historical extremes from right after the pandemic, and it's currently in this stagnation state. It's not yet considered a crisis, but it's definitely in a stagnation state. With boomers aging, higher debt servicing increases, inflation, what's the outlook here? Does the market break out of this stagnation to the upside or to the downside? And really, I think the big question is, can the affordability crisis even be halted?
Well, I think it depends on what side of the fence you're on. If you're a seller, your pain is just starting. If you're a buyer, hopefully we're going to see home prices come down, which, by the way, is the most important aspect when you're buying a house. We've been taught, even by this current administration, the leader, Donald Trump, and his art of the deal. I mean, the way you make money, and this includes homeowners on buying real estate, and that includes the house that you live in, is you buy low and sell high, right? So I think that we're going to have a window of opportunity. Gary, prices always go up. If we look historically at the housing market, prices always climb over time. And it was designed to do that really by the system that we have. You have inflation that happens every single year, right? And that's what drives our economy, right? And then basically home prices historically, we have expected really since before World War I that home prices would increase 3 to 5% per year, keeping up with inflation. And then also that jobs, that your salary you'd get raises, periodic annual raises for rate of inflation, adjusted for inflation. Also in that really 3 to 5% annual your salary increase. And that worked well until, and probably more than anyone, what happened in 1971 when Nixon took us off of the gold standard. That's when this whole unaffordability started, right? That's when it began, but nowhere near like it is today.
So I was going to ask you about that later on, but do you want to talk about that? What happened to housing prices after August 15th, 1971, when Nixon took us off the gold standard?
Yeah, let me show my screen here, if you don't mind. And
now, actually, yes.
All right. So, Gary, I mean, you're talking about what can we expect as far as housing affordability ever coming back into equilibrium again? And really what I say is when you can take your annual pre-taxed income, let's say you make as a combined household income, let's say you make $300,000 or $100,000 a year. Ideal affordability would be to 3x that and don't finance any more than that, right? So if your pre-tax income's $100K, you should not be financing any more for your 30-year fixed rate mortgage than $300,000, right? And a lot of people will say, but I have $200,000 down, so my $100,000 income doesn't really matter because I can buy a $500,000 house because I have $200,000 down. Well, they forget to realize when mom and dad give them gift money that they're buying this bigger house. The costs of operating that house, your property taxes, your insurance, your repair costs, your utility costs, that's all wrapped around the $500,000 house. So here you are. So I don't mean buy a $500,000 house if you have $200,000 to put down if you're only making $100K. What I'm telling you is that if you're financing 97%, putting 3% down, that's the magic number. Treat it like that. If you have $200,000 to put down, then finance $100,000. Don't finance $300. But it's everyone is stretching, and I get it. People want to own a home. It's been driven into us that that's the American dream. When these World War II soldiers came home from fighting, they wanted to start families, right? That was all part of it. They wanted to have their own home. Prior to that, most of homeownership was reserved for the rich, the wealthy. So, and the government did a lot to encourage homeownership. Why? Because it's such a big part of GDP. If you own a house, you get to contribute by paying the property taxes and keeping a lot of companies in business. You buy stuff, you fix it up, you personalize it, you make it your own. Where a rental property, you're going to spend as little money as possible, and so will your landlord. So homeownership definitely drives the cart in America, but with that comes the debt. So let's look at this chart. So basically, I have 3 lines here, and the bottom.
Todd, before you go into this chart, you made 2 very important points that I just want to ask you a question on.
Sure.
The first one is GDP. As far as I know, housing, real estate makes up about 17% roughly of GDP. Am I right in saying that?
No, it's way more than that. 30 to 35%.
Okay, 30 to 35%.
Yeah, because you have to remember, Gary, it's all the housing related items. Right. So you have to throw everything. And it's also a lot of the employment. So blue collar jobs are really big here in the United States. And, so a lot of
that'll make my point even more exaggerated. So here over the last several years, we've seen a stagnating housing market, yet we have seen relatively flat to positive GDP. We're not in recession. Those two metrics don't really correlate. When you take something that's as big as 1/3 of the entire GDP and it stagnates, why are we not seeing that show up in the overall numbers?
Well, I think, first of all, it's how they calculate the numbers, right? So you're looking at samplings of data. And really, I mean, we've been in a recession, but they redefined the term. And what you have to realize a lot of, and going forward with just a tariff discussion, and look, I'm not getting political, but the bottom line is we don't really know what the tariffs are, how it's going to play out right now, right? So it's been an on tariff, off tariff. It's been a changing percentage. This whole thing has been so fluid, and a lot of companies like Home Depot. So you have to think about if you are serving the public, and a lot of the I don't want to go too far down the weeds, but a lot of supply houses, once the shortage happened in the pandemic, they overloaded when they could get supplies. They just overloaded their warehouses with, and a lot of times the wrong supplies. They got burned by it. And then the floodgates opened back up again. But you have to think about, if you are a Home Depot, right? And they've come out and said this. It's been, well documented. If you're a Home Depot and you're expecting that a lot of your imported products are going to go up in cost, what are you going to do? You're going to pre-buy. You're going to stock up. And I think that what we watched happen recently, since this administration has been talking about tariffs, is that people were, companies were buying. So, of course, what is that doing to GDP, right?
Okay.
It hasn't washed out yet. I mean, we are now seeing the slowdown. It's happening
Okay, so
now.
you're saying the front loading because of the threat of tariffs led to higher purchases, increasing inventories, et cetera. However, now that that is behind us, we will see a washout of that, and we should see a reduction in GDP.
That's what I would expect.
Okay. All right. Well, I appreciate that. The other thing I wanted to, before you move on to the chart, is you talked about the rising property taxes and insurance. And oftentimes when people buy a home, they look at that total cost, per month. They say, okay, it's $2,500, $3,500 a month, whatever that number is. With the existing property tax and insurance, they compare it to their debt to income and they say, okay, let's go. If the numbers make sense. Well, it hasn't taken very long, 1 year, 2 years, 3 years, and all of a sudden they're seeing 10, 20, 30, 40% increases in property tax and insurance, and they're not getting a 10, 20, 30, 40% raise, as you were talking about earlier. How are they making the math work? And if they're not, if it's more like an extend and pretend, is there, is there a cliff coming at some point?
Yeah, I think there's definitely a cliff coming. You can look at credit card debt is at an all-time high. And basically that has been how a lot of I wouldn't even say young people, because if you look at the data, a lot of older people, and even after 70-year-olds, their credit card debt is at higher limits than we've seen historically. And when you look at now, a lot of people have refinanced their great mortgage rate because some loan officer told them it was a great idea to refinance to get rid of their 24.5 or 25 or 30% credit card debt interest rate, that payment that they're paying every month or not paying. So they consolidated that, gave up their low mortgage rate. So now it's taking time. I mean, we have bailed out over 1 million households. The American Rescue Act bailed out over 1 million. I don't even know what that number is today, but have more. I think Fannie Mae just said they're on their 27th sale of non-performing loans, where many of these people have had 2, 3, 5, 6 remodifications. It's masked right now. We're not seeing it. As a real estate broker, I can't see these foreclosures that I could look at back in 2008 because we didn't have this type of trickery to keep it out of the public eye. So when you're dealing with, let's just go over the increase in a mortgage payment. People buy a house, especially a first-time homeowner. If you've bought a home before, you know what's coming. You're home mortgage is going to increase year over year. But a lot of our first time buyers, they don't know that, or they're banking or being qualified on a certain amount of money, right? They're told don't make any big purchases that they're going to do because they wouldn't qualify for the loan. So they say, don't go out and buy a car. Don't go out and buy furniture for your house and put it on credit cards. Don't create any kind of debt because it will change what you qualify for. And then, of course, they need those things anyway. Their car breaks down. They have to go out and buy a brand new car, or they start having kids. But basically what happens is, and I can't tell you, Gary, how many emails, phone calls, comments that I have received from people that have bought their home in 21, 22, 23. Their payment has gone up $800 a month, right? So, and as a result of taxes and insurance, that's worse depending on where you live and whether your insurance company threatens to cancel you after you just bought your house, because now they send someone out to look at the house and you need a new roof. And if you don't put a $20,000 roof on it in a certain amount of days, they're canceling your policy, right? They want the adjuster to come back out again and see that there's a new roof installed. But these and HOA fees, I mean, we haven't even talked about that, the increase in HOA fees. So your taxes, your insurance, and your HOAs, they're going up year over year. And a lot of these people are getting hit with that, saying, now I'm enslaved to my house.
Yeah.
Right. And not to mention, we have, unemployment. God forbid one of these multiple borrowers on the mortgage, they need all of their money. And sometimes it's not just a couple or, a husband and a wife. A lot of times what we've seen lately is the multi-generational. Grandma moved in the house and they needed her Social Security to pay for everything. So God forbid we start to see unemployment rates change. We will be heading off a cliff.
All right. Appreciate you, that little sidebar. Let's go ahead and go back to the chart here that you were starting. Sorry for the interruption.
No problem. All right. So Gary, this chart I put together for my viewers, and, I was just trying to think, because a lot of people are saying, and the interest rate, we need interest rates to come down. If interest rates change from where they are now and drop a full percentage point to 5.5%, it basically changes very little. And by the way, just as a reminder, the Fed dropped the rate. The Fed rate's we're recording about 4.5%, the Fed overnight trading rate, which has nothing to do with mortgages. Right. But the Fed dropped it to near zero in 2007, and the housing market tanked. And mortgage rates were suppressed too. So what people need right now is both. They need price reduction and lower mortgage rates. I would like to see double-digit mortgage rates. People think I'm crazy and I'm a real estate broker. I make money when I sell houses. But I know that the chart that we're going to look at here, it doesn't make sense. So we'll just kind of look at this. I took this back to 1963, all right? I could go back even further. The problem is that a lot of this data isn't that easy to find when you get really, beyond that time period. But you can see the bottom line here, the blue line is basically the Federal Reserve wasn't tracking the median household incomes, okay, until really about 1984. So what I did is I sort of mined for the information and put that blue line together, but it's still very consistent, and it matches up almost perfectly to the green line, which is when the Federal Reserve started documenting and recording this data. But basically, that is median household income. And you can see almost through today where it is. Hasn't gone up a whole lot, right? So basically, the orange line, remember I was saying that we typically lean on or want or expect is the better word, your home appreciation to be somewhere in that 3 to 5% year over year annual increase, because that moves along with wages. It should. And you can afford a house that way. That's what they tell you. Well, if you would take that, I averaged it at 4%, right in the middle. If you take your home price or home value and you add 4% year over year compounding, the end of this orange line here is where home prices should be 4%, okay, year over year. Does that make sense so far?
Yeah.
Okay. Now, what happened was that Nixon took us off the gold standard August 15th, 1971. That's when he killed it, right? It was happening before, but Nixon officially killed the gold standard August 15th, 1971. Now that top line is what happened, and I'm tracking, by the way, just to be fair, I'm tracking the median sales price of new construction. And the reason I did that for this chart is because new construction really predicates existing value. And the reason is because would you rather buy an existing home or a new home? Most people, if it's affordably priced or they can swing it, most buyers would love that new construction. Right now, we can get into the fact that they may not like HOAs and they like the older homes and the more. We've had some crap construction in existing homes through the years. The 80s wasn't a very good time for quality in home construction. But so this is new home prices. So you watch that, see that line. So soon as we had 1971, we disconnected from the gold standard. Guess what they allowed to happen? They allowed the asset price to go above and further out of reach of median household income. Now, they try to do this fancy walking. They did it after World War II, when at one point in time, when you bought a house, you had to put 50% down. They said, well, that's no good. Only the rich could do that. And then the government came in after World War II when banks were going bankrupt because home values were falling 50%. So you back in the day, you had on average, let's say a 5-year loan, and you put, let's say the house was $5,000, which they were less 40 some hundred on average back then. But let's just say for the purpose of ease, $5,000 house, you would put half, 50% down. That's 2,500. You would pay 5 years of interest to the bank. And by the way, the average interest rate back in the 30s was 6 to 7% for mortgage rates. You would pay interest only on the loan for 5 years. And at the end of your 5-year, your balloon payment was the remaining principal balance of $2,500. Well, when the Depression hit and people lost their jobs, home values fell 50%. Banks went bankrupt because guess what? They're getting the asset back and it's only worth 50% of what they established a loan for. So they started going bankrupt. The government came in and said, that's not good. We need to extend the term, reduce the amount of money down. And as a result of doing all these things, because Americans buy monthly payments, you can see today, and a lot more has happened through the years, but you can see today where the home price is so far away from that median household income. And by the way, back then only it was an average of one income in the house. Now you have at least two, right? Mom stayed home, right, took care of the kids, raised the kids. Now you need mom and dad, and they're working extra jobs to pay for this. And this chart just shows it.
This is a good spot for this question. When you look at a chart of home equity versus debt, the U.S. housing industry was positive, meaning aggregate homeowners had more equity than mortgage debt until 2008, the great financial crisis. And here you could see on your chart the turn down. Okay. So that lasted until 2013, which is roughly where it started ticking back up on your chart again, right above 2020. Fed responded buying mortgage-backed securities, that dot right there. So there was positive home equity of about 3 trillion ish. In the 12 years since 2013, homeowners on the whole aggregate now have about 22 trillion to the upside. They're literally flush in home equity 7 times the previous housing bubble's peak, which was about 3 trillion. Is this real because of inflation, or is this a mirage and we're just in this like jumbo bubble that is going to burst and people think they have home equity, but they really don't?
Well, I mean, I would say probably during the pandemic boom, it created most of that when we saw home values almost double, and they did double in a lot of markets, but easily 40% in 3 year period, we saw 40% home value increase, right? And so, of course, if you're sitting there on a house that you bought pre 2020, you're if based on what you paid prior to 2020, of course, you're sitting on an average of, I think they say $313,000 in equity per mortgage borrower, right? If you average that all out, because certainly, I mean, if you're financing a house for 30 years, you can't look at the snapshot of the last 4 or 5 years of the people who obtained loans. So the bulk of them are either, and we're only talking about mortgage bearers here. We're not talking about the ones that have no mortgage on their property, but I've read anywhere from 300 to 330,000 as what they say per borrower of equity on their home. All right. So yeah. So would that be real? I guess yes, if you could sell it. It's like buying a stock, right? I mean, if you don't lose unless you sell, right? So as long as you hold on to that stock, you may eventually, if you can't get it now, you may eventually get that and more. I mean, if you wait another decade, this thing's going to wash out. Pain's eventually going to show up. It has to. The tricks are going to end. I mean, you can only pull so many rabbits out of your hat before finally we're where we are right now, where people are saying, you're telling me things are great, but I have no money to go to the grocery store. I'm buying necessities on my credit card and I can't afford my rent, let alone buy some overvalued house where they tell me the value is.
Right. So I hear that the home equity is real, but I also hear pain is coming, which means I'm assuming values are going to drop, which means equity is going to drop as well.
Well, values have already dropped. I think they say there was just a recent Yahoo article. I think it said 19 out of the last or 19 out of the 50 major markets in the U.S. have experienced year-over-year price declines. So we are already starting to see the values drop. The problem is that people are looking at it and saying, well, that's not enough. Like it may only be a couple $1,000. That's no price cut at all when they've gone up 40%. But the problem is they're not selling. So if you want to get buyers off, this is a long run of record low sales. So you want to talk about the effects of negative GDP. You want to talk about having a recession or an outright depression. You don't find a way to make these homes sell or have people have money in their pockets again. We're at the end of the rope. I mean, seriously.
So, okay, so let's go back to the interest rate discussion. I think we could probably be done with this chart for now. Let's go back to the interest rate discussion. If Trump gets his way and they lower interest rates 300 basis points on the short end, that doesn't mean that the 10-year note's going to drop. In fact, the 10-year note could still go much higher. But let's just assume that the 10-year drops and mortgage rates drop correspondingly. Wouldn't that ultimately lead to a dramatic increase in demand, which would then turn around and see prices go up once again because of the demand on the home? So just because folks are wanting this interest rate decline doesn't mean they're going to get a price decline and or an affordability decline.
Gary, builders have been offering rates in the 5% and now even in the 4.99%. So just under 5%. Home builders have been offering this for several years now, and it hasn't worked. And they've had to not only do rate buy downs, which are expensive. So if you want to test the market, the new home market is a fantastic place to test it out, right? Because an existing owner of a house does not need to sell their home unless they're in financial distress. They're not going to get off their 2.75 mortgage or their 3.5% mortgage because the home is too big. They're not going to sell the house because if they did, number one, based on the price that they bought it at, pre-2020, wherever that was, whatever they buy nowadays, if they're not moving in with their kids or going to a retirement community, they're basically going to spend a lot more money for a much smaller home. And so this is locking them up, right? So existing sellers do not need to sell. And in fact, this is one of the reasons why inventory is so low. So now we have to look at and say, well, is new home construction low? Well, you can argue and say, oh yeah, well, we need, 1 million more homes or 3 million more homes to be built, and the builders aren't doing it. They can't sell the ones they have. I mean, they're offering rate buy downs, incentives, and everything they can do to not drop the price because it pisses everybody else off that just bought a house or is under contract for a house to be delivered. So they're trying to protect that. And now we're seeing them pull in the sizes, right? We're seeing, okay, well, let's reduce the size of the house, same floor plan. It looks the same. And then that way it doesn't upset the apple cart. The existing homeowners that previously bought their bigger houses say, yeah, but you bought one of the smaller houses. Or we're selling our house now, but it's the bigger version in the community. An interest rate drop, in my opinion, and again, I would love to come on here. People think Todd's been speaking doom and gloom. I'm speaking facts, right?
Yeah.
We are not doing well in our economy, despite what anybody is, spewing out of their pie hole, right? What's happening here is we're seeing people not afford the bare necessities. And I'm not talking about the upper 5% or 2% of population. I'm talking about the bulk of the movers and shakers of our GDP and that spend money, right?
Okay, so let's stay on the new build and talk about some more fact. Todd, the new build prices are substantially lower than existing homes right now. That's only happened one other time, June of 2005. It's about $40,000 lower. Also, you were mentioning the incentives. Companies like Leonard, they're giving as much as $40,000 in these incentives. So we're talking the real price difference between new builds and existing homes is like $80,000, which is really bananas. Prior to this situation, since 2012, new builds, they averaged $53,000 higher, more expensive. So between the $80,000 lower and the $53,000 higher, we're literally at $130,000 differential right now than any other time that we've seen. Why the anomaly? And is this a signal of some kind for what's coming?
Well, what I said was, existing home sellers don't have to sell. New home builders have to sell. They have a carrying cost every single day that they don't sell that house. And if they're in HOAs, and I'm sure all of them are, unless you're a scattered home builder and you bulldozed an old house or found a lot that you could build on, if you're one of these tract home builders, they're all HOAs. And basically, they're even paying into the HOA. And a lot of people don't realize that. As you're dedicating the new streets to the HOA, the HOA is formed. Usually the builder's on the board of the HOA. They're trying to keep the HOA fees low. The builder has to contribute to that. So they have HOA fees. They're paying carrying costs every single day. Plus, a lot of these new builds, the contracts fell through, so they had these ready to deliver houses. What happens to a house that sits? They're meant to be lived in. Well, they start to deteriorate. You have problems. Now you need to pay to cut the grass. You got to constantly send people in to clean them, make sure the windows are cleaned in a dusty new construction environment. You have to make them look showroom ready every single day. And, so it's no doubt they're dropping prices, right? They have to move this inventory. But to the point, Gary, it's not working. It's not solving the problem, right? We're not seeing a flood. And the other thing is, why aren't investors going in and buying these houses that are $80,000 undervalued maybe? It's because a lot of these institutional investors that have Wall Street economists, they know this is not over yet. You can continue to say that it is and that you drop interest rates, things are going to skyrocket. I may be proved wrong. I will 100% admit it. If this doesn't continue in the downward trend that we're headed, but I don't think I'm wrong.
That's interesting. Okay, so Todd, you talked about the narrative earlier of this housing shortage in the U.S. Interestingly, household formation, which you also talked about, a metric that tells how many people live in the same house, that's begun rising this year. It's implying that generations are moving in with each other, whether it be the kids or the parents, and that's likely due to the incredibly high cost of home ownership, right? So is the housing shortage narrative real or is it false? By the way, inventory has risen almost 25% year over year, which it's like, okay, if we don't have enough houses, why is it risen so much?
I have never believed that we had a housing shortage. We have a active inventory shortage. So we have a lot of inventory that is sitting vacant. If you look at the amount of people that bought second homes during the pandemic boom, it's a lot. And you're right. We've seen there during the pandemic, more than 1 million millennials moved back home with mom and dad or grandma. Okay. And because they couldn't afford where they were, maybe they were let go, they were laid off. It was their opportunity to save money, whatever the reason. We also watch generational housing boom again, right? This multifamily type of environment. I can't tell you how many people that that we've helped where mom and dad bought the house, but they took the small in-law suite, and the kids are paying them a mortgage, right? They bought it cash because they're rich, they have a lot of money. So the baby boomers and the Gen Xers are the ones with all the wealth. And they're, by the way, the ones that are given the false narrative of home prices increasing. And I guess it's not a false narrative, but we're just not telling the truth. If the bulk of the people, if you look at median home prices in a certain period, but you take out all the lower price and increase all the cash buying rich, of course the values of the prices, the median value is going to go up year over year. But that's just not the reality of things. But yeah, what I think is going to happen here is as we have this wave, Yahoo Finance last year, I think it was in October, published an article that said we were going to have 30 million households of baby boomers retire in the next 5 years. That's 6 million inventory per year of existing homes going on the market. We didn't see it yet. So if you want to say it's going to still be in 5 years, that increases the amount for the next 4 years. No one wants this. The younger generation doesn't want your 5,000 square foot, baby boomer house or 4,500 square. They can't afford to heat and cool the thing. So what are you going to do with these McMansions? Bulldoze them or turn them into apartment buildings? Not just that, but what about the Airbnb boom where we took everybody from staying at hotels and everybody bought houses to rent out on a short-term basis of 2 or 3 days or a week at a time? That was a lot of inventory that got gobbled up. Not a housing shortage, but a lack of existing home inventory. The builders don't want to build more because they're not selling them.
So I do have a question on the Airbnb, but I'm going to hold off on that one for a second. Let's stay on inventory. We've seen inventory in the Northeast and the Midwest not recovered, with some markets even seeing bidding wars despite high rates, high prices, and low affordability. In fact, I have a friend that he and his wife, they're moving. They put a bid on a home in a $500,000 neighborhood, and the bidding war went as high as $50,000 over asking price. This just happened like 2 weeks ago, which is very shocking that it's still going on. Do you expect the softening that's occurring in the South and the West to spread to all the regions in the United States?
Well, it doesn't matter what state it's in. They always comment on my channel, not in my neighborhood, and my neighbor just sold, or my friend just like you're saying, Gary, they're like, oh yeah, but my friend just bought this, or my neighbor just sold his house. You have to look, and this is the problem with education. People look as far as their nose. And I'm not saying that as an insult to your question, but what happens is people will listen to headline news and that's as far as it goes. Or they'll listen to their friend and that's as far. Your friends lie, not your friends, but I'm saying they want to make it seem like, oh my gosh, things are way more exaggerated. And
well, he's actually a realtor. So
well,
he went up there, he went up
worse,
expecting to actually be able to buy under, and he got outbid on that particular home.
Look, everything is market specific. Okay. I'm not saying that we don't have the pockets in Maryland doing the same exact thing, but I am telling you that I don't think that there will be any area untouched. right?
Wow.
Even Miami, where they said it would never happen, is having a horrible time right now with an average of 80 days on the market and price reductions that they swore up and down would never happen. The problem with the Northeast, where you're mentioning, when you get into the Northeast areas, is there is actually no new construction or very limited new construction. So a lot of this has been intentional where that will hold prices high. But let me tell you something. The tech hub of Boston, Massachusetts, you let that tech industry start to weaken, right? Which a lot of people expect will happen because a lot of their jobs are going to be taken over by AI. That's what they're expecting. Well, we'll see what happens then when they can't afford these, $1 million houses on that really should be priced probably half of that. So, to your point, I get it. Real estate agents want to keep the narrative going, right? Because the worst thing a real estate agent wants is, to not be able to buy a house or help their client sell a house. They don't get paid commission. But if your agent, friend, or whatever, they should have known what was going to happen. Was the house priced too low? Was he trying to steal the deal and he was looking at a house that was at $500,000 that he's trying to go in at 450? When
No,
really,
he bid over asking by 10, thinking that they would just, secure it and move on. And he was shocked to find out that he was outbid by 40.
a smart agent is going to use exuberance in the first couple days of that house sitting on the market to try and get buyers to compete with one another. I can't tell you why we're still seeing these types of things happen, but I am telling you that nationwide it is spreading. Where I just had a podcast with a friend of mine. He's a broker in Chicago, Illinois. We podcasted 6 months ago. He said, Todd, it ain't happening here. The market's firecracker hot. Yesterday was a completely different story.
All right. So you're expecting it to be like the pandemic and it'll eventually reach all corners of the United States.
I think it will. And some states will crash. Look, if your price went up the highest, you'll probably fall the most.
Okay.
I mean, that's, if you've had, modest price hikes, then you'll have modest price declines. So a lot of it's just, we'll see how it plays out.
All right. So only 24% of U.S. home sales last year went to first-time home buyers. That's the lowest share in history. How is this sustainable? I mean, that younger generation is the largest generation since the boomers. How is this sustainable when you have that large of a cohort? Won't there be an uproar at some point that they can't buy homes?
Well, I mean, it's, and the age went up to 39 years old, and that's crazy. So when you look at 59 years of age was the bulk of the buyers last year, right? They weren't first time buyers. They were repeat buyers with a lot of money and a lot of cash. And a lot of people are mad at baby boomers and Generation Xers because they feel like they got the short end of the stick. They got screwed. We haven't done a good job as, as parents, not as good a job, in my opinion, as we, and I put myself in the same camp, as educating children on how to be financially literate. And what happens is we want them to have it better than we had. And as a result, they don't know as much, right? They're not as savvy. And, so a lot of them live paycheck to paycheck because they don't make enough money, right? I think that what we'll see, instead of an uprising, I think we're going to start seeing where Gen Zs and, this alpha generation that's coming, I think we're going to start to see them become more entrepreneurial. I think we're going to see them start their own businesses. They're going to be like, I watch my millennial sibling. They're struggling paycheck to paycheck, grinding in this job, waiting for some type of raise on an annual basis. And then them saying that they don't have the money, their company saying they don't have enough money to do it. And I think we're going to see where they're going to break out. I do see a brighter future for our youth coming up. I think it's just going to take some reality to take a hold. It's going to take some pain. It's going to take some people losing their homes, having their cars repossessed, being let go, laid off. The same thing that's happened historically in generations. We have to stop pretending. You cannot give 12th place ribbons, right? Everyone's not going to get a ribbon or a trophy. You can't do it.
Okay,
People
so
have to learn.
It's pretty loud and clear coming through that that's funny, by the way, that you're expecting, you're expecting some pain here, and it could be over a couple year period of time. Speaking to that point, Todd, banks, they're tightening lending standards as consumer credit scores, they're dropping for multiple reasons. And debt to income ratios are rising, which by the way, I read recently how high they're allowing these to go. It's actually quite shocking that they're willing to take on that kind of risk. But is this tightening lending standards trend expected to continue? And if it does, what type of ramifications would you expect that to have?
So back before World War II, you had to put 50% down to finance a house, right? I personally believe we talk about, well, we're not going to have an '08 crisis. And look, we're not going to have something that looks like an '08 crisis because we're not going to see the foreclosures because the government is, I mean, Fannie and Freddie, who are the big insurers of conventional loans, they're not letting them foreclose. They're basically bundling up these loans into NPLs, which are non-performing loans, or RPLs, which is reperforming. And that's after they've gone through modifications. They're bundling them up, selling them off to Wall Street type investors, smaller investors too. They're two different size pools. But the point of the matter is, okay, so we're not going to see the '08 crisis of foreclosures. That doesn't mean that we're not going to see home prices come down. But the bottom line is, you're right, debt is at all-time highs. Are we going to have a debt jubilee to wipe out these debts? Well, college students thought that was going to be the case because the Biden administration was telling them all, we're going to get rid of your student loans. Or they were alluding to that anyway. So why in the hell would you pay your student loan debt, even if it's interest free, if one day you're going to have mud on your face and say, well, my buddy didn't pay for his and I kept paying for mine? Well, guess what? The new administration says you owe the money. We're going to attach your wages. We want to get paid, right? So when people sign contracts or take on debt, you got to pay it back. It should be no different than a mortgage payment, right? But again, I mean, it comes back to the same thing. I think that we are and look, you learn by your leaders. If you don't have to run by a budget and you can deficit spend and you can continue to kick the can down the road, and that's the message that we're sending to everyone else, the people, of course they're going to do the same thing.
Yeah. Yeah. And, so just that one point that you just made about signing contracts and whatnot, that implies pain is coming, especially since the Trump administration is saying all loans need to be paid back. But there's so much more on top of that. So you brought up Airbnbs earlier. Lisa Cook, Federal Reserve, she was recently fired from the Federal Reserve for mortgage fraud involving primary residence claims for two different properties in two different states, signed documents like within a month of each other. Mm-hmm. Do you think there's a significant percentage of Airbnb investors who have done similar things over the last 4 years? And could this become a real issue for the housing sector?
When you buy a house and you're claiming that as your primary residence, I mean, if it's a rental, it should be a commercial loan. That's how I did all of mine, right? I mean, you basically, you get whatever the prevailing rate is for your commercial loan. You maybe have a 5-year term. It's amortized over 25 years. It balloons or you refinance it. I had one of my properties shortly after COVID, a commercial property. The bank refused to refinance it because they didn't want, I'm a perfect pay. I mean, I was never late on my payments. And they basically said, we don't have an appetite for it. And you got to pay it off. We'll give you an extension, 60 days, 90 days. Tell us what you want, but you got to pay it off or refinance with another bank. But when you buy a house and you sign affidavits at the closing table, those loan documents that say you're going to live in there, I believe that they expect, I think it's 12 months, that you actually make that your primary residence for 12 months. If you're lying on the loan application, I'm no attorney, but that does sound like mortgage fraud if you're purposefully signing. Now, whether this was the case with the Fed, who knows?
I'm more interested actually in the hordes of people that own Airbnbs.
It probably is a lot. I mean, I wouldn't be able to say because I'm not sitting at the closing. Believe me, don't tell me that you're committing mortgage fraud and expect me to help you buy a house.
Right.
I don't want to be involved in that, right? And but does it happen? I mean, people are confused though a lot. So I don't think FHA, and I've read some conflicting things on this, but I think FHA. I don't think you're allowed to have an Airbnb in an FHA, a short-term rental. But I could be wrong on that. But I think I'm right. But what the big thing is a lot of people think it's mortgage fraud if you buy a townhouse or a condo and you live in it for 3 or 4 years or whatever, or past the time, maybe it's 12 months, and you decide you want to keep it and you move out and buy a bigger house, but keep that as a rental. That's not mortgage fraud, but it could be tax fraud if you're not letting the taxing authority know that it's no longer your primary residence, so you shouldn't be getting homestead tax. So I'm sure the fraud is just all throughout the industry.
Yeah, I think the main question is, and we don't need to belabor this one, but I think the main question is if there are hordes of people who own Airbnbs that have followed in the same footsteps as Lisa, is that something that is going to come out in the wash at some point? And then if so, what's the ramifications? But
Gary, we hear lip service on everything, and then we see very little things that have been done. I mean,
that's fair.
Who knows? Who knows? Right now, it's in the news, and I think if anything, the servicers should be the ones this should be pushed back to. You know what? If they or the underwriters, if they underwrote it, and whatever the guidelines were, it should be their responsibility to buy those notes back.
Okay. All right. So, when we were talking off camera by email, you had mentioned a lawsuit and that there are some ramifications to that. People who sold their homes between 2019 and 2025, they paid what critics argue as inflated real estate commissions, and they filed a class action lawsuit. Can you tell us, where things stand with that? And does that open the door for lower commissions to be paid to realtors?
Well, I mean, it depends obviously on who you ask, right? So I think that it has reduced transparency in a lot of ways, which to me, and it would be very convoluted to explain this, but I'll try and be just as simple as I can about the lawsuit. Basically, a group of sellers got together. The class action lawsuit was that one of the sort of premises of the whole thing was, why should I be paying a buyer agent commission to negotiate against me? I think it's a fair question. I mean, I think if over the last 100 years, the way it works is, everybody prior to buyer agency, and again, I don't want to go in the weeds too far down the road, but prior to buyer agency, when it was ruled that buyers should have a fiduciary or a representative, before that, everybody worked for the seller. And that's kind of where this commission came from, right? So even if you didn't know them, if you had a buyer, you brought them to the seller. Technically speaking, you work for the seller. And so the seller paid a commission, and then that commission was shared in some way, whether it was split in the middle or, commissions are always negotiable. But that was how it was done. Then they came out with this buyer agency, and then they became fancy with it and said that it was going to be a cooperating compensation, meaning that they have a buyer's agent, signed contract, fiduciary, but the seller still paid the listing agent the full amount of their agreed listing commission, and then the listing broker paid the buyer broker a percentage that was very transparent in the MLS, so we could see that. The problem was, like any bad actors in any industry, the problem with that is you could steer your clients away. If I could look at a commission that's online and it's a lesser amount than house B, some agents would sway their buyers, downplay or down talk the lower commission house to go for that bigger commission amount or a bonus or whatever. And that was all on the MLS. Well, the DOJ's been after the National Association of Realtors for decades. But basically, all of this sort of came to a head, and the end result was you can't put commissions on the website. So now the agents keep it to themselves. And I think that this is helping some agents make even more money. And so there is no transparency in that. And as a result, we're expecting our buyers to sign contracts, buyer agency agreements in all 50 states now. And if there's no buyer agents commission offered from the seller or the listing broker in that contract, that all buyers having a buyer's agent, they have to sign that they owe a fee to their agent. That's not financed. Just like lender fees, you got to write a check out of pocket. And what we're seeing happen as a result is that buyer's agent with a buyer broker agreement with their buyer, they're actually now standing in between the buyer getting that house where there's no compensation offered. And basically, unless they can stroke a check or renegotiate for a fee for that buyer's agent, they can't buy that house. So that's why, one of the reasons why, Gary, I have a buyer course that I developed, because I'm educating home buyers that are in this being screwed right now, potentially being screwed with the lack of ability to buy a house because of an agreement they signed with their buyer agent. So it's a mess. I do understand one thing. They needed more transparency, and this has forced buyer agents to be honest with their buyers, because before they would say stuff like, well, we're free, and then you don't have to pay us anything. We're free. Well, the bottom line is the buyer's paying it regardless, because if the buyer doesn't buy the house, nobody's getting paid. And then the people were showing up at the settlement table and they were looking and like, damn, you weren't free. You just made 15 grand, dude. My mom and dad gave me a gift. I've drained my account to buy the house. You didn't tell me you were walking away with 15 grand. So, it's this industry is, it's not, unfortunately, it's not very highly regarded.
Yeah. Well, I appreciate that answer. And it looks to me like your course is extremely timely. So I hope those who are tuning in and watching will take advantage of that and get the education that they need. This has been an incredible discussion, Todd. I just want to welcome everyone who's tuning into this interview with Todd Sachs, broker of Sachs Realty and the host of the Sachs Realty Podcast. Before we wrap up here, I want to direct everyone interested in the metals and mining sector to dive into our Substack at metalsandminers.substack.com. Join the quickly growing community and receive a free report. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." That's a famous quote by investing legend Ray Dalio, and that's the name of the report. I'm also positive that you've been enjoying the conversation that Todd and I have been having. Please let him know, hit the like and subscribe button, and leave a comment below the video. All right, Todd, as we're getting ready to wrap up here, one of the big questions that everybody has is, the boomer generation, they own the majority of the wealth. They own a lot of the homes. Some of them own, 2, 3, 4, 5 of them. They're starting to age out, and many of them are going to be passing away. They're going to need to be selling. And, what are you expecting over the next 5, 10, 15 years as the boomer generation goes deeper and deeper, in age?
Well, I think one of the scariest, I just interviewed someone who owns retirement communities, and he's talked about the massive shortage that we have for mom and dad, places for them to go and, and age the last 3 years of their life on average. And, these places take their house in a lot of cases. So, I think a lot of people are expecting to get some of mom and dad's wealth, and they may find out that because of this, they don't get anything when it comes to the house. It's really, people need to plan, right? So, and I'm not a planner. I'm not a financial advisor. I'm a real estate broker. But I think that what we have to realize is that people need to have real conversations with mom and dad. And, say, look, how can we do this life together? How can we make things work? What is the plan? Because most people don't share the plan, and they don't like to talk about the plan. I mean, it's like going out and, you want to get your burial site. No, it's not something you want to talk about. But I think that what has to happen, and I think that as we're going through any kind of downturn, these are opportunities for us to come together, reunite with your family, have discussions on what does that look like? How will the next 10 years be for you, mom or dad? And, how can we incorporate this in a life together so that we can enjoy ourselves on the time that we have?
Todd, thank you for coming on to Metals and Miners. I really appreciate you being so generous with your time and analysis and ideas. It's really been a lot of fun to spend the time with you. Would you please let everyone know where they can learn about your work and how they can connect with you?
Yeah, well, you can follow us on our Sachs Realty Podcast. We're on we're on YouTube. We are on every major audio platform. We're also on every social media as well. And I thank you, Gary. I mean, I think if you know someone that's looking to buy a house, it's not just for first time buyers. Go to saxrealty.education. All right. I'm sure, Gary, you'll probably hopefully publish the link as well. But check it out. My course teaches the best way I can help people in buying a house, giving them advice, is to actually have them take my course. It's about just shy of 9 hours, 14 lessons. If you don't want to, you could pick. I mean, you get all 14 lessons. If you only want half of them, that's important to you. But it's not just for first-time buyers either. The market's changed. I teach you how to negotiate with your real estate agents, and I even teach you how to transact should you not even want a buyer's agent. So I appreciate, Gary, you let me have that little plug there. And,
Yeah, no problem.
I certainly, look, as you see, I speak what's on my mind.
Yeah, I appreciate that about you. I have followed you for probably almost close to 2 years. I've really enjoyed your various interviews. You did one with Peter Schiff. I enjoyed that one. You're doing a great job. I appreciate the education you're bringing. I'll have all of your information up on the screen. It'll also be links in the description area for everybody to click through. Guys, go ahead and check out all that Todd has to offer, the education, the YouTube channel, the courses, etc. Follow him. Get on Twitter, X, and follow him as well. Todd, thanks again for coming on. I appreciate it. Look forward to having you on sometime soon.
Thanks
Everybody
so much,
else,
Gary.
thanks for watching. Welcome everyone who's tuning in to this interview with Todd Sachs, broker of Sachs Realty and the host of the Sachs Realty Podcast. Before we wrap up here, I want to direct everyone interested in the metals and mining sector to dive into our Substack at metalsandminers.substack.com. Join the quickly growing community and receive a free report. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." That's a famous quote by investing legend Ray Dalio, and that's the name of the report.